I tend to stick to the highly liquid ETFs because I want to buy the total market. I don't want to take a chance on one individual stock going down when the rest of the market is going up. I want to participate in the full advance. And the only way I can do that is by buying a basket of stocks in ETFs. So I try to simplify my trading as much as possible. I got one decision here. When do I enter, and then when do I add? Sorry, that's two decisions. When do I enter, and when do I add to my position? So we enter on these low volatility days. We enter when the market looks like it's starting to stabilize. We get these small ranging bars, and at that point we put on our position. So we put on our position. So let's say we're going to add. We started to look at the end of April. So we started to add at this point. We put one contract on. Let's say we buy one call on the diamonds. Now, advances tend to last a lot longer than declines. So we want to try to buy the longest expiration date that we possibly can on the diamonds if we're going with the diamonds. And then what we want to do is we want to look for opportunities to add to that position as the market continues to rise. So another great opportunity to add to the position was this decline right here. You can see, even though it was a decline, look how small these red bars are. The actual range in which the declines took place was relatively small, so there wasn't a lot of volatility. Even though the market did decline here, volatility was relatively low. So we want to add to the position here. So now we've got two positions. We've got our initial position, and we've got another position that we've added to it. Another thing that's really crucial about advances is understanding the concept of flags. When a market continues to go higher like this, what it does is it creates what's called flag patterns. And these, basically the flag pattern looks like a flag. You've got this kind of sideways to downward movement based on this kind of pole here. So you got like a little flag. And those happen throughout the entire advance. It happens more often than not. In fact, that's the way markets actually go up. So you got this flag, you got this flag here, and then as the market continued to go higher, you can see additional little flags. So it gave you additional opportunities to add to that position. This is the most basic form of trading. If you think the market is going to go higher, you simply trade on the flag patterns. When it appears that the flag pattern is over, you want to go long again, add to your position, and continue to leverage that position up to an important high. Now right in here, you start to see the wide-ranging bars again. The bars start to get a little bit wider, and we get a little bit more volatility coming into the market. And that's the point. Remember, normally the first time that happens, it does not mean the end of the rally. But volatility is starting to come into the market here because you can see how wide-ranging these bars are. Not just one, but several bars become wide-ranging. At that point, either you do a final add to the position with a very tight stop, and then at some point, I would say this day, we pointed out this day before, this one particular day, where you had a wide-ranging bar on extremely high volume. All of a sudden, the volume on the downside started to tick up dramatically as it did back here. So we had a couple of days of really high volume here. Volume was starting to come into the volatility was starting to come into the market. We know that the first time it enters the market is generally not the top. We wait. We get, and then we start to look here, and then as soon as we get this bar here on high volume, and we get this bar here on high volume, then we get this bar here on high volume. You got to take note of that, and at that point, I would be looking to exit the position right in here. So trading to the long side is a very, very basic strategy. You just look for at the beginning of the rally, you look for those small range bars to get involved. You look at flag patterns to add to your position, and then you exit when you see volatility starting to increase on the upside. In the next video, I'm going to show you one of my favorite ways to trade. We're going to talk about ratio trading. So we talked about volatility trading in high volatility environments and in low volatility environments. Now we're going to talk about a secret technique used by very few professionals, the 1% of the top professionals that actually make a lot of money in the market. It's called ratio trading, and we're going to get into that in the very next video.